Welcome to the Retirement Wealth Podcast. We're so glad you're joining us today.
Absolutely, Emily. It's great to be here. Planning for retirement can feel a bit overwhelming at times.
Right? And one of the biggest concerns is figuring out how to choose low-risk investments that can help ensure a comfortable retirement.
Exactly. Many folks want that peace of mind, knowing their money is working for them without taking unnecessary risks.
So today, we're going to dive into some practical strategies and insights on how to select those low-risk investments. We'll cover things like the different types of low-risk options available, tips on balancing your portfolio, and how to align your investments with your retirement goals.
And let's not forget, we'll also touch on the importance of understanding your risk tolerance. It's crucial to know how much risk you can comfortably handle as you plan for your future.
Yes, and we'll share some common pitfalls to avoid, which is super important for anyone looking to secure their financial future.
It really is. So whether you're just starting to think about retirement or you're already enjoying it, there's something here for everyone.
All right, let's jump right in. David, can you start by explaining what we mean by low-risk investments and why they're so important for retirement planning?
Emily, choosing low-risk investments for retirement isn't just one of those topics that's nice to know about. It's really crucial right now.
Absolutely, David. With so much uncertainty in the economy, I think folks are feeling a heightened sense of urgency about their retirement plans.
Right? We've seen significant market volatility lately, and that can really shake people's confidence. For someone who's nearing retirement, it can feel especially alarming. Like, one day the market's up, and the next, it's down.
Yeah, it can be so disheartening. I was talking to a listener recently who mentioned that they were counting on their investments to carry them through retirement, but with the fluctuations, they're feeling anxious about their plans.
Exactly. And when you think about it, their timeline is shrinking. They can't afford to wait for the market to bounce back if they're planning to retire in just a couple of years.
Right, and inflation is another big factor right now. Prices are rising on everything from groceries to healthcare.
Yes, and that's where low-risk investments become even more vital. If you're not careful, inflation can really eat away at your purchasing power. I remember working with a couple, let's call them Tom and Susan. They thought they had a solid investment plan, but didn't factor in inflation adequately. They were shocked to realize how much more they'd need each year just to maintain their lifestyle.
That's a great point. It's not just about having a nest egg, but ensuring that it lasts and keeps up with those rising costs.
Absolutely. And we also can't ignore the changes to Social Security and how they could impact retirement planning.
Oh yes, that's a conversation worth having. Social Security benefits have been changing, and some folks might not realize that the cost of living adjustments aren't always enough to keep pace with inflation.
Very true. I had a client who was really counting on Social Security as a big part of their income. When we looked at the numbers together, it was clear that they needed a more diversified approach to their income sources.
That's so important. It's like relying solely on one source of income can be risky.
Exactly. And if we look at healthcare costs, that's another layer of complexity. As people age, medical expenses tend to rise.
I know many people are surprised by how much they need to budget for healthcare in retirement.
Yes, a recent study found that a couple retiring today might need about $300,000 just to cover healthcare expenses throughout retirement. That's a huge number, and it's often underestimated.
So if you're not factoring those costs into your retirement planning, you could be in for a rude awakening.
Right, and that's where low-risk investments can really shine. They can help provide a stable income stream that's less affected by market swings, and that can be a lifesaver for healthcare expenses.
It really can. Plus, you've got to think about the emotional side of things too. Financial security can impact your peace of mind.
Oh, definitely. I've seen it firsthand. People who feel secure about their finances tend to enjoy their retirement much more. They can focus on traveling, spending time with family, and pursuing hobbies instead of worrying about money.
That's a great point. I've heard stories from retirees who've taken a lot of stress off their shoulders by adjusting their investment strategies to be more conservative as they entered retirement.
Yes, and it's not just about the numbers, it's about the quality of life. A friend of mine, Jim, once shared how shifting some of his investments into low-risk options allowed him to finally take that trip he'd always dreamed of, without worrying if his savings would hold out.
That sounds liberating. And I think that's what so many people want. Freedom in retirement without financial stress.
Exactly. And as we think about legacy planning, low-risk investments can help ensure that you leave something behind for your loved ones.
Right, you want to be able to pass on your values, and hopefully some financial security too.
Yes, it's all interconnected. The current economic trends really highlight the importance of having a balanced approach that considers both growth potential and risk management.
So true. All of these factors really emphasize the need for a solid, low-risk investment strategy as you approach retirement.
And with all that in mind, we should transition into some core strategies that can help listeners create a more stable financial future. So let's dive into some core strategies and rules of thumb for choosing low-risk investments for retirement. One of the foundational things to consider is your asset allocation, right?
Exactly. And, when we talk about asset allocation, it's really about balancing your investments between stocks and bonds. A common rule of thumb is the 70-30 portfolio. That's 70% in stocks and 30% in bonds, which is great for growth while still maintaining some stability.
Right, but as you approach retirement, you might want to shift that ratio more towards bonds. So maybe a 60-40 or even a 50-50 split to reduce risk. The goal is to preserve capital while still having some growth potential.
Totally makes sense. And speaking of bonds, they're often seen as a safer investment. But not all bonds are created equal, right? You have government bonds, municipal bonds, and corporate bonds, each with different risk levels.
Exactly. Treasury bonds are typically the safest, backed by the U.S. government, while corporate bonds can offer higher yields but come with more risk. So it's about finding that balance and understanding what you're comfortable with.
Yeah, and I think it's also important to talk about tax-advantaged accounts. Like, if you're using a 401k or an IRA, that can really help you grow your savings without the tax burden until you withdraw.
Definitely. And with a Roth IRA, you're paying taxes up front but can withdraw tax-free in retirement. That can be a great strategy to consider, especially if you expect to be in a higher tax bracket later on.
Right, and you mentioned withdrawals. That ties into the 4% rule, which is a popular guideline for how much you can withdraw from your retirement savings each year. So if you have $1 million saved, withdrawing 4% means you take out about $40,000 annually.
Exactly. And that's meant to help you avoid running out of money. But the 4% rule isn't set in stone. Market conditions, your personal situation, and longevity can all affect how much you should really be withdrawing.
So true. That's where having a personalized plan comes into play. Some folks might prefer using a bucket strategy, right? Where you divide your investments into different buckets based on when you'll need the money.
Yes. The first bucket could be for short-term needs like the next 5 years, invested in cash or short-term bonds, while the second bucket might be for medium-term needs, maybe invested in a mix of bonds and conservative stocks. And then the last bucket could be for long-term growth, invested more aggressively in stocks.
I love that idea. It really helps to structure your withdrawals and manage risk. And when it comes to diversification, that's another key principle for protecting your retirement portfolio.
Absolutely. Diversification means spreading your investments across different asset classes, sectors, and geographies to reduce risk. So instead of just having all your money in one stock or sector, you want to mix. Like, if one industry takes a hit, your overall portfolio won't suffer as dramatically.
Right. And that relates back to real estate, too. Investing in real estate can provide a steady income stream and potential appreciation, but it also comes with its own risks and management requirements.
Exactly. Real estate can be a great way to diversify, but it's important to understand the market and your own comfort with managing properties. Also, don't forget about the tax benefits of real estate, like depreciation.
Yeah, tax savings techniques are crucial, especially in retirement. You might want to look at strategies like tax loss harvesting to offset gains, or even considering how your withdrawals will affect your tax situation.
That's a great point. For instance, if you strategically withdraw from your tax-deferred accounts like a traditional 401k or IRA in lower income years, you can minimize the tax hit. And thinking about your Social Security strategy is also vital.
Absolutely. Timing your Social Security benefits can really impact your overall retirement income. If you can wait until age 70 to start, you can increase your monthly benefit significantly compared to taking it at 62.
Right. And it's a balancing act. You have to consider your health, your financial needs, and your other retirement income sources. Making the right choice can mean thousands of dollars over your retirement.
And don't forget about required minimum distributions, or RMDs. Once you hit 72, you'll need to start withdrawing from your tax-deferred accounts, which can affect your tax bracket and overall retirement income strategy.
Exactly. That's why having a well-thought-out withdrawal strategy is so important to ensure you're not caught off guard when those RMDs kick in.
So, it sounds like there are a lot of moving parts to consider when planning for low-risk investments. But if you can implement these core strategies and maintain flexibility, you'll be in a much better position in retirement.
Yes, and remember, it's all about finding what works for you personally. Everyone's situation is unique, so having a tailored plan can make all the difference.
Well said, David. Now, with all these strategies in mind, it's important to also be aware of some common pitfalls that could derail your retirement plans. Shall we dive into those next?
So, Emily, one of the biggest pitfalls I see when people are planning for retirement is the sequence of returns risk.
Yeah, I've heard of that. It sounds a bit intimidating. Can you explain what it really means?
Sure. So it's all about the order in which your investment returns happen. If you hit a market downturn early in retirement, it can really impact your portfolio, even if the long-term returns are good.
Right, I see. So, if someone retires just before a market crash...
Exactly. They might find themselves withdrawing money from a declining portfolio, which can deplete their funds much faster than if they had a stable return in those early years.
Have you seen this happen with any clients?
Oh, definitely. There was a couple I worked with a few years back. They retired in 2008, right before the financial crisis. Their portfolio took a huge hit, and they were withdrawing money to cover living expenses. It was a tough situation for them.
That sounds stressful. So what could they have done differently?
They could have had a more diversified strategy, maybe keeping a portion in cash or bonds to cover their expenses for the first few years. That way, they wouldn't have to sell off stocks at a low point.
That makes sense. What about taxes? I imagine that's another big area where people trip up.
For sure. Many retirees overlook the impact of taxes on their withdrawals. They might withdraw from their accounts without considering how it affects their tax bracket.
Can you give an example of that?
Absolutely. I had a client who was withdrawing from their traditional IRA without a strategy. They didn't realize that by taking out large sums, they were pushing themselves into a higher tax bracket.
Ouch! That could really eat into their retirement savings.
Exactly. They ended up paying a lot more in taxes than they needed to. If they'd planned their withdrawals better, like spreading them out or using more tax-efficient accounts, they could have saved a lot.
So it's really about having that tax strategy in place, right?
Yes. And speaking of strategies, let's talk about healthcare costs. Many people underestimate those expenses, and as we know, they can add up quickly in retirement.
I can imagine, especially with rising healthcare costs and longer life expectancies.
Right. I had another couple who thought they'd be fine with a certain amount set aside for healthcare, but they didn't account for long-term care. They ended up needing more than they had planned for, which put a strain on their finances.
Wow, that's a tough lesson. So what would you suggest to avoid that situation?
It's crucial to include healthcare costs in your retirement planning. Look into long-term care insurance and consider ways to estimate your future healthcare expenses.
That sounds like smart advice. And what about asset allocation?
That's another common mistake. People often stick to the same allocation they had while they were working, without adjusting for their new retirement phase.
So they could be too aggressive or too conservative?
Exactly. I once had a client who was still heavily invested in stocks, but they were in their late 60s. The market volatility was really stressing them out, and it wasn't appropriate for their stage in life.
I can see how that would be nerve-wracking. How do you help clients find the right balance?
We focus on their risk tolerance and income needs. It's about finding that sweet spot where they're not exposing themselves to unnecessary risk, but also not missing out on potential growth.
That sounds really important. And then there's Social Security, right? I know people sometimes claim it too early.
Yes, claiming Social Security too early can be a costly mistake. A lot of people don't realize that waiting a few additional years can significantly increase their monthly benefit.
I can see how that could make a big difference over time.
Definitely. I had a client who claimed at 62, thinking it was the best option. But when we ran the numbers, if they had waited until 70, their benefits would have increased by nearly 75%.
Wow, that's a huge difference.
It really is. So I always encourage clients to explore their Social Security options thoroughly and think about their overall retirement income strategy.
Sounds like a lot to keep in mind. Are there any red flags people should watch for early in their retirement planning?
For sure. One big red flag is if someone is overly reliant on one income source like Social Security without a diversified income strategy.
Yeah, that can be risky. What else should they look out for?
If they're not regularly reviewing their financial plan or if they've never run a retirement income projection, that's concerning. It's important to know if you're on track or if adjustments are needed.
Those sound like great insights.
And having too much debt as they enter retirement is another red flag. It can really limit their cash flow and flexibility.
I can see how that would be a burden. So what can someone do if they find themselves in one of these situations?
Well, the first step is to reassess their financial plan and make necessary adjustments. If they're unsure where to start, talking to a financial advisor can help clarify their options.
It sounds like a proactive approach is key.
Absolutely. And remember, it's never too late to make changes. Whether it's adjusting asset allocation or developing a withdrawal strategy, taking action now can lead to a more secure retirement.
That's really encouraging, David. It's all about being informed and making the right choices along the way.
Exactly. And that's what we're here for, to help guide listeners as they navigate their retirement journey.
So, what's the next step for someone who wants to ensure they're on the right track?
I'd recommend starting by evaluating your current financial situation, understanding your income sources, and considering your long-term goals.
Great advice, and I guess finding a trusted advisor can also help with that process.
Yes, definitely. A good advisor will take the time to understand your unique situation and help you develop a personalized plan.
That sounds like a solid plan for anyone approaching retirement. Thanks for sharing all this valuable information, David.
Of course, Emily. It's important to equip everyone with the right tools to ensure a fulfilling retirement.
And I think we're wrapping up this segment here.
Sounds good. All right, so let's dive into some immediate steps that folks can take right now to start choosing low-risk investments for their retirement, yeah?
Absolutely. I think one of the first things people can do is to check out some online retirement calculators. You know, platforms like Vanguard, Fidelity, or Charles Schwab, they all have these really user-friendly tools that can help you get a sense of where you stand.
Right, and those calculators can help you estimate your retirement savings needs based on your lifestyle, expected expenses, and even your anticipated retirement age. It's a great way to start setting some realistic goals.
And it's also super important to review your current investment portfolio regularly, right? I mean, quarterly reviews can really keep you on track and help you adjust if things aren't going as planned.
Exactly. You want to make sure that your asset allocation aligns with your risk tolerance and retirement goals. If you find that you're taking on more risk than you're comfortable with, it might be time to shift some of those funds into safer investments.
Yeah, and speaking of shifting funds, a lot of people might not be aware of how tax efficient their investments are. Using tax software to run simulations on how different investments could affect your tax situation can be really eye-opening.
That's a great point. Understanding the tax implications of your investments can really help you make smarter decisions. Plus, if you're not sure where to start, the IRS website has resources, and you can also check out ssa.gov for Social Security estimates.
Right, and let's not forget about the importance of financial planning apps. There are so many out there that can help you track your expenses and investments, making it easier to see where you can cut back and save more for retirement.
Absolutely. Apps like Mint or Personal Capital can help you visualize your financial situation and keep tabs on your progress. It's all about making those small, manageable changes that can lead to big results over time.
And that brings us to another habit that's super valuable, running retirement projections. Just taking some time to model out different scenarios can give you clarity on whether you're on the right track or if adjustments are needed.
Yes, even if you're already retired, it's never too late to run those projections. You want to ensure your plan is still working for you based on your current expenses and lifestyle changes.
And speaking of lifestyle, I think it's crucial for people to consider their spending habits. Starting small by tracking daily expenses can really illuminate where your money is going and help you find areas to save.
Definitely. And once you have a clearer picture, it's easier to make informed decisions about reallocating those funds towards low-risk investments. Maybe it's time to look into bonds or bond funds, which can offer more stability.
That's a smart move. Plus, for those who enjoy reading, there are some fantastic books out there about retirement planning. The Boglehead's Guide to Retirement Planning is one I often recommend.
Great choice. It offers solid advice on low-cost investing and how to build a portfolio that aligns with your retirement goals. And for those who prefer podcasts, there are plenty, like The Retirement Answer Man, which breaks down important topics in a really relatable way.
Those resources can make a world of difference, huh? Just having that knowledge can empower people to take control of their financial future.
Exactly. And while it might feel overwhelming at first, starting with small, actionable steps can lead to significant improvements over time.
It's all about progress, not perfection. And even if you're starting later than you'd like, remember, it's never too late to improve your plan and make those adjustments that can really set you up for success.
Well said. So those are some practical first steps. Now let's bring this all together. Well, Emily, as we wrap up this episode, I think we've covered some really important points about choosing low-risk investments for retirement.
Absolutely, David. So to recap, one key takeaway is understanding your risk tolerance. Knowing how much risk you're comfortable with can really guide your investment choices.
Right, and another point we touched on is the importance of diversification. Spreading your investments across different asset classes can help minimize risks while still aiming for growth.
And don't forget about liquidity. Having some easily accessible funds can give you peace of mind, especially when unexpected expenses pop up.
Exactly. It's all about balancing your need for security with the potential for some growth. And we also discussed how essential it is to regularly review and adjust your portfolio, right?
Yes, staying proactive with your investments is key. Markets change, and so do our needs as we move through retirement.
Well, it's really about building and protecting your retirement wealth, isn't it? Making informed choices today can set you up for a more secure tomorrow.
For sure. And listeners, we encourage you to think about these strategies as you plan. Remember, it's never too late to make adjustments that could benefit your retirement journey.
If you found this episode helpful, please like, subscribe, and let us know your biggest takeaway or any questions you have in the comments.
And don't forget to share this episode with someone who's planning for or already in retirement. We want to help as many people as we can.
Speaking of helping, next time we'll dive into tax planning strategies after retirement. It's such an important topic that can really impact your overall financial health.
Definitely something to look forward to.
All right, everyone. Thanks for tuning in today.
We appreciate you being here with us.
Until next time.
Take care.